Thank you for being with us. Once again, I want to thank you, those who have been watching our videos and they want to discuss double entry system of accounting. Last time we were talking about the regulatory framework, the financial reporting regulatory framework, and I think those who watched that video, you saw how the financial reporting is regulated both globally and weekly. So we want to look at double entry system, and of course this is the recording system which involves recording transactions. So the rule is that for every entry that is debit, there must be a corresponding credit entry, and for every credit there must be a corresponding debit entry. So now, if for example a transaction happens, there must be a losing side, and of course there must be a gaining side. So the losing side is credited depending on the account, and the gaining side is debited. So we are going to look at the structure of the account that is either debited or credited depending on the transaction, but also depending on the type of the account. Now, an account by definition is the record in a summarized form and in a chronological order, in an order of transactions that took place in an entity. So here I think a very good example here, for purposes of summarization, we summarize an account in a T format. We have a debit side, which is on the left, then the title, which type of account. Is it the equities account? Is it an account for expenses? Is it an account for rent? Is it an account for transport? The type. Then it also has the credit side. So depending. For example, this is like rent. If you pay out rent, you debit rent. But if you're paying rent using cash, you credit the cash. Because cash is losing, but rent is an expense. So when expenses are increasing, they are debited. And when revenue or incomes are increasing, they are credited. And when they are reducing, they are debited. We shall see that right. We need to first look at the types of the accounts. And one, we have personal accounts. Personal accounts are ledger accounts that appears in the names of patrons. For example, an account can be named John. An account can be named Julius. So specifically, these accounts records debtors and creditors. Meaning, if you get goods on credit from someone, that one is a creditor. But you cannot create an account called creditor and then you credit it with the amount that you got on credit. No. But if you get goods on credit from another person, how can you differentiate those two suppliers? So in this case, we put their real names, personal names. And these accounts are called personal accounts. So I have given an example of debtors and creditors specifically. But also we have a personal accounts. These ones do not contain the name of the person or the business. Now they are divided into real accounts and the nominal accounts. Real accounts the accounts that relates to assets, physical non-current assets. For example, if you buy land, you open up land's account. That account neither have the name of the person or the seller, neither does it have the name of the buyer. So it has its own account. Whether the land has been bought on credit, no. What we do, we code it and then we open up a land's account, and this account is real. This account is real. Another type of a personal account is a nominal account, and these ones relates to intangible items. For example, if you make sales, how do we record sales? Of course, we record sales in the sales ledger account. You paid out rent expenses. You paid out rent. You write rent account and you debit it when it's credited with either bank or card, depending on the method that you have used to pay. So those are nominal accounts. Then we have the third category. We have capital accounts, and this one records all capital resources are invested by the proprietors or the shareholders of the company or the capital contributors. So now we are going to see the effect of transactions on different accounts. If a transaction happens, what is the effect on the account depending on the type of the account? We have a chart here that is showing the details of the effects of the transactions on different accounts. So if assets are increasing, for example, you had one piece of land and you have bought another piece, that account your assets have increased or your land has accumulated. So what you do, you delete this account. That is an asset. Then if you sell out land has reduced, you credit it. And if we still have land at the end of the year, the normal balance must be a debit side. Must be a debit balance. Liabilities. Liabilities, examples of liabilities, we have loans, long-term loans, we have short-term loans, we have debentures, we have deferred tax liabilities, we have expenses payable, accrued expenses, current tax payable, we have bank overdraft, we have trade payables, and others. We have very many liabilities. So now if liabilities are increasing, if for example you had a loan of 20 millions and then you go for another loan, it comes to 40. If it increases, you credit the loan's account and then you debit. If you're getting that loan and money is deposited on your bank account, you debit back, credit loan's account. So now the normal balance must be credited. If at all, the liability is still outstanding at the date of reporting, must be on credit side. Then capital. Usually capital has a credit balance because if you introduce capital in business, you are either introducing it in the form of assets, in the form of cash at hand, in the form of a cash at bank. So if you are introducing capital through bank, it means that you are going to credit the capital and debit back. Credit capital, debit back. So the capital account, it increases, you credit, and if it reduces, you debit. Eventually, you'll find that at the end, your balance in the books for the ledger accounts, you are getting a credit normal balance. Then incomes or revenue have credits. For example, sales revenue. Credit sales, debit if you are receiving money from sales by cash, debit cash. Credit sales, debit cash. Credit sales, debit bank. And the normal balance or the closing balance must be on credit side. Expenses are debited. Examples of expenses we have rent, have salaries, wages, we have transport, we have depreciation. There are very many. Donations, very many. Those ones are debited. Why? Because you settle expenses by incurring time. So either you are paying through bank or using cash at hand. So cash must be credited. And now the expenses account is debited. So if you pay rent, you have rent account. But also if you're paying rent using a cash, the other side of cash must be reduced, credited. Then rent is debited. So the normal balance of the expenses must be on the debit side. Now we have an example here that we are going to use. We are going to use this example to understand it together. And I want us to pay attention such that we can practically see how the entry works. We have an example here, and it says that Magarwa started a business called Magarwa and Sons and recorded the following transactions. On 1st June, they started the business with cash 100,000. So in this case, we are going to open, but before we start, let us first see what is required. The required is saying prepare ledger accounts and the trial balance as at the end of the month of June. So we want to look at the ledger accounts. Let me paint it another color such that they can get it right. We want to work out the ledger accounts, but also prepare the trial balance from the ledger accounts. So now we can go back and start. They started business with cash 100,000. So here, the accounts that we are going to create are two. One is capital account, and another one is cash account. So capital account here is going to be credited because we are introducing capital into business in form of cash. So cash immediately is going to increase. Why? Because we have introduced the capital. So we are going to credit capital and then debit cash by 100,000. That is happening on fixed. So we have our cash account here, and we are debiting it with the capital. We have done that. Then we are going to look for the cash account and capital. We are going to look for the capital's account and then credit it with the capital's account is here. We are going to credit it with cash of 100,000. So now on the first we are done with the transaction that happened on first, because the principle is every transaction must be recorded twice. We have recorded cash account. We have debited the cash by typical. This happened on first. And maybe it may be yellow. Then we have credited the capital with the cash here on first. Capital's account is being affected by cash. Then on second, paid for rents. Maybe paid rent by cash 35,000. So now the rent is an expense and the cash is an asset. So we are going to debit because we are paying rent by cash. We are going to debit rent and credit cash with 35,000. So now our cash account is here. That is happening on second. Rent is 35,000. Then we go back, we go the other side. Let me paint it here also. Then we are paying by cash. Cash account has been affected. Then also rent, cash, that is 35,000. So we have also, we have posted that in the ledger accounts. Then that is done also. Every transaction must be recorded twice. So let's go now to the transaction that happened on the 4th. Paid for furniture, 25,000 by cash. Furniture here, furniture is an asset. Now, cash is a current asset also. So these ones are your accounts. Both are your accounts. We are going now to pay for furniture, partially used, but we gain the furniture as a non-current asset. We are going to credit the cash with the furniture of how much? Of 25,000. Furniture here, 25,000. 25,000. Let me take that. Furniture 25. Then we go to furniture's account. We debit it. Let's go to furniture. We debit it with 25,000. With 25,000. Furniture is here. We are paying cash 25,000. So that one is also worked out. Double entry means record every transaction twice. So now that is a transaction that happened on 4th. So now we are going to look at the transaction that happened on 6th. Bought stock for sale at 45,000 cash. So this is inventory or stock. Inventory or stock. They bought inventory at 45,000 using cash. Cash must be reduced by inventory. Credit cash. Credit cash by 45. Let me call it stock such that the way it is recorded in the question. Stock. And they are telling us the figure is 45,000. Credit stock. Let me paint it yellow also. But now we need to have the account for inventory and debit it with the cash on 6 is 45,000. 45,000. thousands. 45,000. 35,000. Let me paint it yellow such that we can get it right. There we are. That transaction of 6 is also done. Double entry means record a transaction twice. There must be a losing side, there must be a gaining side, therefore debit a corresponding account. Then that one is worked out. Then 7th, they sold the stock for cash. The stock that they had bought on 6th, part of it was sold at 10,000. So now cash is increasing because we are receiving money from what? From sales. We are receiving money from sales worth 10,000. 10,000. 10,000. That one is recorded. Then a corresponding entry will go to sales. We have made a sale. We have made a sale. We have made a sale. Let us follow this sale of the accounts. Sales. So the transaction is happening on sold stock 10,007. So we are crediting stock. I mean, we are crediting sales and debiting cash. Sales here. So why? Because of cash 10,000. But the debt must be altered. The debt is that happened on 7th. So we go back to sales. This is 7th, but not 20th. 7th. Good. That one is worked out. So another transaction happened on 10th, and they also sold the stock on credit, 15,000 to James. So now, depending on their approval basis, yes, we have sold on credit, but we must recognize the sale, whether we have received the money or not. That is accrual. We assume that whether we have received money or not, we have made a sale. Sales, we have made sales of 15,000 to James. James now is our debt, our asset. So we are going to debit James and credit sales by 15. Now James must be debited by sales. Sales and on credit. So we have said, let's go back to the question and see 15,000. 15,000 James. Here, 15,000. That is worked out. So James must be debited. Why are we debiting James? Because you have sold him on credit. And if you sell him on credit, then it means that is our data, is our current asset. So now here, this account must be also credited by James. James. Just a minute. James. By 15,000. So this transaction is happening on the 10th. So here we can put 10th, 10th, like that. 10th, we are selling on a credit goods worth 15,000. Members, what we need to understand is that our entry says that every transaction must be recorded twice. So if you don't record it twice, then you are not honoring the rules of double entry, and therefore at the end, the trial balance will not balance. So that is a transaction that happened on 10th, and it is done. Then on 15th, they bought stock on credit. Stock on credit. Stock on credit from PUK. Then what we do, our stock increased. But of course we have a creditor, PUK. So we are going now to credit PUK because creditors are liabilities, and then debit stock. Then debit stock. We have 45,000. Credit PUK with 45,000. Then debit stock 45 here. 45,000. And we paint it yellow such that we can see the transaction clearly. A corresponding debit will go to stock. Stock increased by PUK, and the amount is 45,000. 45,000. So let me work it out here. Good. The 5,000. So now let us move. Another transaction happened on 20th, and they received 8,000 from James. You remember we had sold goods on credit to James here. I had sold goods on credit to James, and James is paying. We are going to assume because the transaction is silent. How did we receive this money? We are going to assume that is on cash basis. We are going to debit cash and credit James because remember our James is our debt. So credit James with cash, and of course 8,000. 8,000 credit James with 8,000. That transaction happened on 20th. Yeah, 8,000. Then now we need to debit cash because James paid by cash. Cash account is here. 8,000. 8,000. So that transaction is also done. That transaction is worked out. Good. Then another transaction happened on, according to the question here, another transaction. Let's go back to the question and check. On 22nd, they paid PUK 12,000. Remember, we had bought goods from PUK on credit. And now we are paying back to PUK 12,000. So what you do, you go to cash, account, and you credit it to the PUK 12,000. Cash is here, 12,000. PUK is here, 12,000. So remember, 12,000. Then a corresponding entry, we go to PUK and debit. Because if liabilities are reducing, we debit. PUK is here. When liabilities are reducing, they are debited. PUK by 15. Is it 15 or 12? Let's go back. Is PUK here? It is 12,000. So let us go and debit PUK amount equivalent to the others. That one is done. I'm choosing to go slow such that you can get the concepts. So another transaction happened on 25th. They sold the stock for cash. It started 2,000. So we are going to look at sales. We made sales from 32, and now we sales of 32, and now cash increased, but the sales account must be credited. So we are going now to debit the cash. Debit the cash by 32 here. 32,000. But also credit sales. But also credit sales. So we are going to look for sales accounts and credit it with the cash. Here. This with cash. So I'm going to have it here. Cash that's 2. So that transaction happened on 25th. happened on 20. So that is worked out. Now what follows? We have followed our entry. All the transactions have been entered into ledger accounts. Following our entry. So we are asked to prepare ledger accounts. Now, after preparing these ledger accounts, we have a task of balancing them. Balance them. Balance here, but also balance here. So I would advise that you leave some gap here and then put the lines after leaving some gaps. So look for the bigger side. Of course, here the bigger side is the debit side, because if you look at the figures, 100,000 plus 10,000 plus 8,000, this is 40,000. This is about 150,000. 50,000. That is the total here. Now, if this does not add 150,000, then bring this total here. Bring this total 150,000. Then you see, if you add these 35 plus 25, what do you get? You get about 60. 60 plus 45, 105 plus 12, 127. If you get 150 minus 127, let us work it from here. 150,000 let me use the calculator here. 150 minus 127, you get 23,000. So now if you get 23,000, it means that the balance here, let us balance carried down will be 23,000. Now, this is how we balance the ledger accounts. I'm going to balance this one, and then you'll balance the others. Now, this balance carried down here. This balance, you bring it here now. Bring it here, balance. Brought down. Just, sorry for that. Balance brought down. Over and 3,000. I'm going to paint it red such that you get what I'm talking about. So now I'm going to explain how do you treat this figure. I have balanced the cash account. Now, what do you do when you are extracting the trial balance from the ledger accounts? Because the trial balance by definition is a list of balances from the ledger accounts. After balancing, what remains? Because we have seen the receipts, what we received from the transactions on the debit side. Then you have put all the payments on credit side. The payments we made using cash. What remains is this 23,000. And if you find what remains is this 23, and therefore that is the balance that will go to the trial balance. I'm going now to show you the format. I'm going to show you the format. The trial balance is here. So meaning our cash has a balance of 23,000. You bring it here in the trial balance, the way we have balanced and the way we have gotten it. This is the balance for cash. Go to furniture. Balance furniture. Furniture is here. So if you balance this side, if you balance this side, the total is 25 here. But also, the total this side is 25. This is how we balance, because on the credit side, we do not see depreciation. An asset, a non-current asset account can be reduced by depreciation, can be reduced by the disposal of some of the furniture, can be reduced by impairment, can be reduced by any erosion in value or disposal. And of course, a disposal is a bigger term. Maybe I will have to prepare something and then I'll share with you about the disposals. So now both sides are balancing. But now here, the balance brought down will now be 25. Now that balance will come this side after putting there the two lines. If you are using a paper and pen, this balance will come here as the balance carried down. Of how much? 25,000. So that is how you balance. So if you go to furniture, the trial balance, furniture will stand at 25,000 on debit side. 25,000. So that is how you extract balances from ledger accounts to the trial balance. Likewise to stock, likewise to capital, rent. You do for rent, then do for creditors, do for debtors, and if you follow the double entry, these two totals must be the same. The total here and the total here and the total here must be the same. The total here must be the same. The debit side total must be equal to the credit side total. So now what you do, you are going to balance all the ledgers, the PUK ledger, sales ledger, then furniture. I have balanced it. Balance for rent. Rent automatically when you balance, you'll get it at 35. And on debit, 35,000. Then James, you balance for James. At first, James was our debtor, and he paid us 8,000. I think he remained with he owes us 7,000, and therefore, and being a debtor, 7,000 on debit side. Then sales, you work it out to here, 10 plus 15 plus 32. This becomes now 25 plus 32 becomes 37. 37 home sales. Then here you include sales here. I had not put it at the 7 here, that's 7,000. There's some other account you have to, depending on how we have opened them. Then rent is how much? If you can go to rent, the rent is that way. Do you record that? I think yes. Rent is 35 or so here. Then we go back. You remember we had the capital. Capital is on a credit side. So we come here and we record the capital here. Capital here is 100,000. So debtors, I think this 7,000 was debtors. 7,000. That and this one was certain a figure. That's certain a figure here. So creditors. Our creditor was PUK. PUK. We were demanding him 45, but he paid us 12. So 45, if we rest 12 from 45, you remain with 33,000. So now creditor 33,000. So look for, there are some other accounts you need now to look for here. Include them. Make sure the totals are adding up and you're getting the same balances. So for addition, I think we'll do that is double entry. Follow the double entry in ledger accounts and then you'll get the correct trial balance. The next session we shall be looking at the errors that cannot be detected by the trial balance, but also we shall look at the cash book. So make sure if you find this video relevant, make sure you subscribe such that whenever we post a video, you are notified that you have shared some content. Thank you very much. May God bless you.